Hi everyone, I'm Amelia from the Brand Experience team, your co-host, and welcome to another episode of Providence Money Wisdom Podcast. So today we have with us Chris, our CEO, to talk about his latest Business Times article titled "Investing in the S&P 500 alone is not the silver bullet." Wow, sounds like a controversial title. So Chris, a silver bullet is something like a simple and seemingly magical solution to a complicated problem. So why do you think investors started to view the S&P 500 so positively? Is it because of recency biasness?
Yeah, I think you are right. I think if I remember correctly, I think the S&P 500 since April of 2009, right after the global financial crisis, it started its bull run until the end of, if I'm not wrong, 2021, right? Because in 2022, then we had a pretty bad year. Not just S&P 500, but the rest of the market. And if you look at the last 10 years returns, the S&P 500 would have done about 180% cumulatively.
Wow.
So I mean, it had a good 10 years bull run, and somehow it made investors think that actually investing is not that difficult, because if I just invest in the S&P 500 and I stay invested for 10 years, then I will get the returns that I want, right? Or I get the returns that I need. And to make S&P 500 even more attractive, Warren Buffett advocated it. In fact, Mr. Buffett says that all you need to do is really just invest in the S&P 500, and then don't look at it, and you'll get your returns. And because of that, today even in many blogs, even in many finance community groups, I hear of a lot of people saying that you actually just need to invest in the S&P 500 and then you are going to get the returns that you want. So I think because of all these things, the S&P 500 index has been getting a lot of attention, and a lot of investors are just depending on it to get the returns that they want.
I see. Interesting. Okay, so what prompted you to investigate the performance of the S&P 500 versus the MSCI All Country World Index over such a long period?
I think there are three reasons. The first reason is actually, I know from experience and from my memory that there were periods in the past whereby the S&P 500 was flat. And I wanted to investigate that. I wanted to compare with the MSCI World to see how both the index they do. Also, more recently, someone actually commented to me that if they had invested in if they invested in the S&P 500 index, say 5 to 7 years ago, they would have done much better than our Providence equity portfolio. Now, although that's factually true, it is true that if you invest in the S&P 500 index alone, you would have done better than our equity portfolio. But however, the problem with that is that is on benefit of hindsight. I mean, 5-7 years ago, how would you know that the S&P 500 will give you the performance that it has given, that you are getting now?
That's true.
Right? That's one. And like I said, there have been periods before in the S&P 500 whereby you don't get the returns. And it is possible that the last 7 years could be a flat year. Right? It's just that now you look back and you look at the S&P 500 and you say, yeah, actually it's much better. And so that comment may not be fair. And the other thing is that you are investing in a single country index. And if you are investing in a single country index, you are going to be faced with a lot of volatility.
Yeah.
Like what we had in 2020 of March, when the S&P 500 fell 30% from the peak, just in 1 month. And if you are just investing in one index, perhaps you may not have the risk appetite to take that volatility, and you would have gotten out from your investment. And really there's no returns to talk about. Right? Yes, after that, the S&P 500 recovered. But if you have gotten out of the market, then you will not be able to reap the rewards of that recovery. Right? So again, it's easy to look behind, look back and say that, yeah, if I've invested in the S&P 500, I would have done much better. Right? But I don't think it's a fair comment, because like I said, you didn't know that the S&P 500 would have given you this kind of performance 7 years ago. And really, I mean, do you want to risk all your money and put your money into one single index? So I don't think that that is something that we will do. at Provident, because at Provident, we always say that we are helping clients invest towards their non-negotiable life goals. And because we are helping clients to invest to be able to enable their non-negotiable life goals, we want to find an approach that gives them the highest possibility of success. And investing in the single country index is not our way. I mean, our way of doing that is actually to invest in a broadly diversified portfolio.
Thanks, Chris. It's always on hindsight, right? Yeah. So what are the potential drawbacks or risks associated with global diversification that investors should consider, if any?
Yeah, I mean, as we were running the numbers, right, it was quite clear that if you invest in the S&P 500 instead of a more diversified MSCI all country world index, you are going to get better returns because you are taking concentrated risk.
Yep.
Right? So if you're investing it for the long term, the S&P 500 will give you better results. So the drawback, I would say, in diversification is that you got to accept that your performance may not be as good as investing in a single country index. But like I said, is that drawback worth it? I would say yes, because whilst you can get a higher return in the S&P 500, but because of the great volatility, you might not have that appetite to stay invested, right? So even though the S&P 500 factually gave a better performance, but if you are not going to stay invested, then you are not going to get the returns that the S&P 500 has delivered.
Especially if people pull out of fear, right?
Yeah. So yes, the drawback is a lower return, but the upside is that with lesser volatility, you probably would be able to stay invested for a long period of time. And also in the article, when I compared the S&P 500 with the MSCI All Country World Index, there was a period whereby the S&P 500 experienced a prolonged downturn for 23 months, right? You're not going to get a positive returns. Whereas for the MSCI All Country World Index, it was only 5 months. I mean, how many people can actually stay invested in an index that for 23 months continually give you negative returns, right? So it's tough, and you probably would have pulled out. It's really my point that yes, it may seem attractive, the index, but if you're not going to stay invested to get returns, then what's the point?
Yeah, it's just life's trade-offs. Yeah. So, okay, in your opinion, what role should historical performance play when guiding future investment decisions?
Well, in our world, we always say that historical performance is not an indication of future results, right? So we cannot use historical performance and say that in the future you are going to get the same kind of results, the same performance. But history is a good guide. If we know that there has been a period of time in the past whereby, for example, in this case, the S&P 500 that has given you flat performance, then it is possible that there will be a period in the future that the S&P 500, or for that matter, any index, any investment, that can also give you flat returns, right? So it's a good guide. The second thing is that, at Provident, we always say that we take the estimation of our planning returns very seriously. And the scientific model that we use is the Ibbotson-Chen model, right? And in the Ibbotson-Chen model, in estimating the future expected returns of equities, we take the current risk-free rate plus what we think is the equity risk premium. The equity risk premium is the reward that you will get for taking extra risk over and above the risk-free rate. Right? So that's what equity risk premium is. And we look at the historical performance of the equities market to get the equity risk premium. I mean, that's the only data that we have. We don't have future performance of the equities market, but we have past performance. And by looking at past performance, we are able to get the equity risk premium, the extra return that you will get over and above the risk-free rate. So with that, we would be able to, as accurately as we can, estimate future expected returns of equities. Now it's an estimate, but that's how we use historical performance to do that. And because it's an estimate, and because part of the formula involves historical returns, we review our estimation of expected returns on a very regular basis. Yeah, but still, we make use of historical equities performance to estimate the planning returns that we use for planning for our clients.
Our popular Retire Well ebook has been updated. Retire Well is a methodology that Provident has developed to design a retirement income plan that will provide you with a safe and reliable stream of income for the rest of your life. Check out the link in the show notes below to download a complimentary copy of the full ebook today. Thank you, and let's get back to the episode. But I think that will really give clients a peace of mind. That's my opinion.
Well, I think it's important to have a basis for estimation.
Yeah.
It's better than no basis, right? I mean, today, if I plan for you, Amelia, and I say that, okay, if you put $1 and assuming you put into a 100% equity portfolio and you're going to get, say, 8% return, and then in 20 years' time, you're going to get this amount of money. But if the estimation is based on just wild guess, then the certainty of you getting the amount of money that you need in 20 years' time will be very low, right? At least we use a scientific approach and we try our very best to be as accurate as possible to estimate the returns. And if the returns, they don't come in as what we expect it to be, but at least we know where we have gone wrong. If you make wild guesses, it's very hard to know where it's gone wrong, right?
Yeah.
But if there is a basis, then at least if the performance, they don't actually happen the way we expect them to be, then at least we know where to make the adjustments.
Okay.
Yeah.
So moving on to the next question, could you discuss specific examples where a client actually significantly benefited from a diversified approach compared to just a single index approach?
Yeah, I mean, if I think about it in recent years, one of them I have actually mentioned just now already, which is in March of 2020, when the S&P 500 came down 30% from its peak. I mean, we had almost no panic selling, right? And that's because our clients, they were not invested in the US market alone. They were invested in a globally diversified portfolio, which included other developed markets. It also included emerging markets. Our portfolios, for some of portfolios, they even had bonds inside, right? So the volatility was something that was suitable for the client's risk appetite. And as a result of that, they could stay invested. And as a result of that, when the markets recovered very strongly towards the end of 2020, the clients were in the market to reap the rewards of the recovery. So that was one example, or rather that's one example. The other example really is 2022. Now, 2022, unlike 2023, was a pretty bad year. The equities market came down 21%, generally speaking. And again, in that particular year, we didn't have a lot of clients selling because of panic. Most of our clients stayed invested. In fact, many of our clients put in more money when the markets came down. And because they remained invested in the market, last year, 2023, when the markets recovered very strongly, they were there again to reap the rewards of the recovery. And in fact, 2023, although it ended well, 2023 wasn't an easy year. I mean, especially during the, I think, last quarter, before November, the markets was pretty choppy, right? But clients stayed invested. Had they invest in a single country index, I'm not sure whether it will be the same scenario because it might be too scary and some may pull the plug. And again, whatever recovery we have experienced both towards the end of 2020 as well as in 2023, if you're out of the market, you're out of the market. You're not going to get the returns that the market gives.
Yeah, so we're setting them up for success.
Yeah, that's right.
Okay, so actually moving on to the last question, what advice would you give to investors who are currently heavily invested in the S&P 500? And how should they diversify and where do they begin?
Yeah, I mean, if you want maximum return, then stay invested in the S&P 500, because historically speaking, like I say, it is true that the S&P 500 did very well. But I'm not sure whether the US will also do well in the next 10 to 20 years, right? Because we kept repeating that historical performance is no indication of future results, right? So yes, the S&P 500 has done, in fact, very well over the last 100 years. Will it do the same in the next 10, 20, 30, 40 years? No one knows, right? But if you want very good returns, you want maximum returns, and investing in the single country index, I think is fine. But if you want more certainty, then I think it is safer actually to diversify. You may not get the maximum return, but you have a higher chance of getting the returns that you need to be able to fund your lifestyle, to be able to enable your life goals. Then you must begin to diversify. Now, don't just diversify into other developed markets like Europe or Japan. You should diversify also into the emerging markets, right? Because there were periods in the past when the developed markets were not giving the returns, the emerging markets were doing well. So you want to have some exposure to the emerging markets. And for those of us, maybe because our time horizon is short, or we just don't like volatility, you might even want to invest or rather diversify into bonds, right? Because the purpose of bonds is that it acts as a cushion. The purpose of bonds is that it moderates the volatility of the portfolio so that you can stay invested when the equities market becomes very choppy. And again, I know I sound like a spot recorder, but I'm saying it again. The key here is that you remain invested through the good and the bad times so that you can reap the rewards of your portfolio. It's no point that you put yourself into a very exciting portfolio and you cannot stay invested. And even if that particular index, that particular investment, that particular portfolio, if it does very well, I mean, what's the point? Because you're not there to be able to experience the return, right? Yeah, so the key here is to stay invested. And we cannot think of any other ways, but through diversification. Not just diversification into different asset classes, different countries, regions, segment, but diversification into many securities instead of just buying into 1, 5, 10, 200 securities, but diversify across thousands of securities.
Okay, that's very good advice, Chris. So if anyone needs help, you can look for Chris, can email Chris or email us.
Or email us.
Yes, email us. So anything else to add, Chris?
I think that's about it for this episode.
Okay, that's great. Okay, so that's all for today's episode. So we hope you've enjoyed the podcast. So today's episode is a bit controversial, but you'll be able to find the Business Times link in the description below. And if you like our podcast, please rate us on your favorite podcast platform. And that's all for today's episode. Thank you for listening, and we'll see you next time. Goodbye. All analysis, views, or opinions from interviews, recommendations, and other information broadcasted, podcasted, or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs, or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Provident Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, podcasted, or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior consent of Provident Limited.